Hey, what's up, everyone? My name is Ale. Welcome back to my world of stocks. So, once in a while, I like to review the portfolios of some famous investors and rank their 10 largest stocks from best to worst and share my quick opinion on each one of them. It's a fun thing that we do on the channel. I hope you guys enjoyed. Hit the like button if you do. But today, we're going to be taking a look at none other than Cathie Wood, who I personally am a very big fan of myself. But just putting my own kind of feelings aside, she's become very popular, especially kind of recently, because she's been investing so heavily in disruptive and innovative companies, which most notably would, of course, be Tesla. And Cathie Wood is known as like one of the biggest Tesla bulls out there. But anyway, she is someone who a lot of people like to keep track of. And so we're going to take a look at her portfolio in today's video. Now, she does all of her investing basically through her company called Ark Invest. And to keep things simple, we're just going to specifically look at their most famous ETF called Ark Innovation ETF. And the ticker symbol is ARKK, which it states here that it is focused on Ark's belief that innovation is key to growth and that the ETF is built on the cornerstone investments that present the best risk-reward opportunities from Ark's innovation-based themes. Of course, the portfolio manager for this is Cathie Wood. They have over $25 billion of net assets, which is very high, and they typically hold around 45 stocks. And we're just going to take a look at the top 10 largest, which make up more than half of the entire ETF, and we'll rank them from best to worst at today's prices and based on my own quick opinion. So of course, if you guys disagree with any of my rankings or opinions in this video, make sure you let me know down below in the comment section. I'd love to hear your different thoughts. But kicking things off here with stock number 10, that's going to be a stock that I actually just recently purchased myself this year for the very first time ever, and that is Spotify, ticker symbol SPOT, at over 3% of the ETF. And Spotify is, of course, the largest music streaming service in the entire world, and after paying over $100 million for the Joe Rogan podcast to come over exclusively to Spotify, which, by the way, Joe Rogan podcast is the most popular podcast in the entire world. Well, that's helped them now become the second most used podcast app in America as well. Unfortunately, they are not currently profitable on a net income basis, but sales typically grow at a very high rate every year, with revenue growth of around 20% or more expected both this year and the next. You couple that with the stock currently sitting at the very bottom of their 52-week range and down close to 50% from their highs, and I'd say that this is a stock that is probably worth gambling on here. Long term, I think Spotify has a really good shot at being one of the biggest, if not the biggest competitor to the likes of things like Apple Music and YouTube Video. However, I'm worried about the lack of profitability and how expensive it can be to license all of that content, which I think will be a continued drag on their profits. Still, I do personally like Spotify. I'm invested in them myself, and for these different reasons, I'm going to put them just a little bit higher than the median at number 4, and I'll consider readjusting it as we go through the list and we look at some other stocks. Speaking of which, that brings us to stock number 9, and that's going to be Twilio, ticker symbol TWLO, at about 3.6% of the ETF. And this is a cloud-based communications company that basically uses the cloud to integrate chat, voice, and even video communication features into websites and apps, and their whole kind of selling point is that they can do it much more efficiently and cheaper than the old legacy methods of having to go through telecom carriers that involved a lot more steps and higher price contracts and things like that. But with over 240,000 customers at the end of their last quarter, which was up from 200,000 the year prior, explosive revenue growth of almost 70% that quarter, and an international expansion that has now grown to over 30% of total sales, Twilio is clearly headed in the right direction and has a very real shot of disrupting a massive telecommunications market. Like Spotify though, Twilio is not currently profitable and their net income seems to be getting worse every year. But on the flip side, sales continue to explode and are expected to grow by another 50% this year and another 30% next year as well. But despite the stock sitting near the midpoint of their 52-week range, it is still up by over 500% in just the past 5 years, leaving their valuation very expensive at a price to sales ratio of almost 25. For context, Spotify has a PS ratio of less than 4. So even though I think Twilio has an amazing future potential and all that good stuff, I'm going to have to put them behind Spotify for now in the number 5 spot because it's just a bit too expensive still. Okay, next up though, at stock number 8, we've got Shopify, ticker symbol SHOP, at over 4% of the ETF. And this is, of course, a rising play in the red hot e commerce sector, although they do help with various services for brick and mortar stores as well. But the online shopping area is where they've really been able to shine, primarily by helping small to medium sized businesses set up their entire online shopping infrastructure and really simplify the entire process for them with tons of tools, services, and lots of valuable support. And that success with smaller businesses has even started to leak into larger ones as well, as they've now partnered with the likes of Heineken, Staples, and even General Mills. At this point, if you own a small business yourself, chances are pretty good that you've either used or have at least considered using Shopify yourself. As of now, they're quickly approaching 2 million customers, and although they are just slightly behind WooCommerce in market share in the US, which by the way, I believe WooCommerce is a free to use service and that's kind of gave them a lot of success. But Shopify is still the most searched e-commerce solution according to Google Trends. As a result, sales have been soaring over the years, typically seeing revenue growth of around 50% or more every year. And unlike the other stocks we've talked about earlier, Shopify actually made a profit on the bottom line last year as well. Still, this is a stock that has skyrocketed by over 3,300% in just the past 5 years alone, leaving the valuation very rich with a trailing P ratio of over 76, a forward P ratio of over 232, and a price to sales ratio of close to 50. I like the company, I like the growth, and I like the future potential, but I just can't touch them at this valuation. And for that reason, they're gonna go lower than both Spotify and Twilio. I'm gonna put them at the number 6 ranking for now. Okay, that brings us to stock number 7, the 7th largest of the ETF. And this is a little bit of a coincidence here because they're actually somewhat of a competitor to Shopify, and that is Square, ticker symbol SQ, at about 4.4% of the ETF. And like I said, they're very similar to Shopify. In fact, their online store builder called Squarespace even commands more market share than Shopify if you look at global metrics. But aside from that, you've probably heard of Square yourself just from using one of their little attachments that go on phones or tablets that small businesses often use to accept payments. And that combination of products and also services has made Square a very popular platform to use, and that's in turn led to surging sales that more than doubled last year and helped them reach profitability in each of the last 2 years as well. And as if this wasn't enough, their sales are expected to once again surge by another 100% plus this year before finally cooling back down to around 12% growth the year after. As you might expect though, that amazing performance has sent the stock soaring to some very high levels, as they've now climbed by over 2,000% in just the past 5 years, leaving them trading at an all-time high. Surprisingly though, the valuation isn't as bad as you would expect. Yes, their PE ratios are super high, but that's because they just kind of barely started becoming profitable. Perhaps more importantly, their PS ratio is still less than 9. And in case you don't remember, Shopify was close to 50 and Twilio was almost 25. So because of the lower valuation, the strong global market share, and the very high revenue growth along with 2 consecutive years of profitability, I'm gonna put Square ahead of both Twilio and Shopify in the number 5 ranking and move those other 2 down 1 spot to number 6 and number 7 respectively. Alright guys, that brings us now to stock number 6, 6th largest of the ETF, and that's going to be a company that, along with the V-Shop makers and the giant tech and online shopping behemoths, this is definitely one of the biggest beneficiaries of the global health issue, and that is of course Zoom Video Communications, ticker symbol ZM. And you guys have definitely heard of this one, as in the past year and a half, their online communication platform has been used for online teaching and remote work, and thanks to the pepperoni lockdowns, Zoom was able to grow their customer base by nearly 500% last year. That is huge growth. As a result, sales exploded by over 300% in 2020 and are still expected to continue growing by over 50% this year and another 20% next year as well, even as things start to slowly open up again. And that's because a lot of businesses are actually implementing permanent options for remote work going forward. In fact, according to Gartner research, almost half of all employees say they will continue to work remotely, at least part-time, even after the global health issue passes, which is up from just 30% before the pepperoni. And they also estimate that only a quarter of all enterprise meetings will take place in person, which is down from 60% today, meaning this will be a gigantic market for Zoom to dominate if they can stay on top and continue to execute. By the way, unlike many other stocks on today's list, Zoom is even profitable already, so this is a company that is already firing on all cylinders right now. Of course, all of that promise and performance will come at a very high cost though, if you're thinking about buying the stock, as they are already up by over 400% from their pre-pepperoni levels. As a result, you'd have to take on a forward P ratio that is around 2 to 300% higher than the rest of the sector, and even if we factor in their really high growth for the next 5 years, you're still talking about a PEG ratio that is close to 200% more expensive as well. Even if we just focus on sales, their PS ratio is still over 30. This is a hard one to rank, guys, because I really like them as a business and it's hard to imagine them not getting bigger over time as things turn more and more kind of remote or virtual. But that valuation is just way too rich for my blood, so I think I'll be staying out of this one myself. But as a ranking compared to the others on the list, I think I'd like to put them right around the middle at number 5, and that means I'll have to bump up Spotify and Square to number 3 and number 4 respectively. Yeah, I think that looks good for now. We'll stick with that. Okay, now we're cracking into the top 5 stocks, and coming in at number 5, that's going to be Unity Software, ticker symbol U, at close to 5% of the ETF. Now, Unity is a very interesting one because they're actually a video game software company, and you guys know I love my video games, but looking at them, you've probably heard of Unity just by the Unity engine, which is what many video games run on these days and are essentially developed on. And as it stands, Unity is actually the most used engine in the entire world right now. And because the gaming market has experienced really good growth and will likely continue to well into the future, Unity has been able to tap into that and grow their own sales by around 30 to 40% or more every single year, which is very impressive. Unfortunately though, this is a company that not only loses hundreds of millions of dollars a year because they have to spend so much on research and development and constantly, upgrading their software and all that kind of stuff, but it's also been getting worse every year, and despite the stock currently sitting around the midpoint of their 52-week range after falling heavily from their highs, the valuation is still extremely expensive at a price-to-sales ratio of over 35. I mean, I get it, Unity is probably never going away, and they will only get larger as a company over time, and they might even get acquired at some point too. I could see that happening as well, but at this valuation, you're paying more than what you would pay for something like Zoom, and I'd much rather have Zoom as well as other stocks in the market that are way cheaper and actually profitable. So I'm going to have to place Unity near the bottom reluctantly. I feel sad to do that because I love video games and everything, but I'm going to have to rank them in the number 8 spot just behind the rest for now, because I think I like the others a little bit more. All right, now moving on to stock number 4, that's going to be Coinbase. This is ticker symbol COIN at right about 5% of the ETF. And this is, of course, one of the world's most popular cryptocurrency exchanges where people go to buy and sell crypto. In fact, according to coinmarketcap.com, Coinbase is currently ranked number 2 in the entire world based on various metrics like volume, liquidity, confidence, and traffic. On one hand, there's a ton of upside to Coinbase stock because if cryptocurrencies become more mainstream and accepted in the future, then Coinbase has at least the potential to become the one-stop shop for everything crypto, and that'll mean huge sales and profits. However, on the other hand, there are literally hundreds, if not thousands, of different crypto exchanges out there, and while Coinbase, I have to admit, has more notoriety than a lot of those, I think the obvious concerns here are that number 1, they will always have to compete with others on pricing of fees, and number 2, they are heavily tied to the future of crypto, which is still highly uncertain. I mean, Worst case scenario, we could even see governments step in one day and regulate most cryptos out of existence until only a few government approved ones remain. Obviously, that's also speculation, but the point is that nobody really knows for sure how all of this is going to play out. We're just going to have to kind of wait and see. And even though I wouldn't mind betting on some cryptocurrency myself, I'm not sure that buying the stock of a crypto exchange is that much better or less risky of an alternative. In fact, not only are exchanges heavily dependent on cryptos remaining popular, but in a recent tweet, the CEO of Coinbase even stated that they are actively investing in cryptocurrencies themselves by purchasing over $500 million of crypto and spending another 10% of all profits on crypto going forward as well. That could be good, that could be bad. I have no idea because it's kind of speculation. Now, granted, the stock has fallen quite a bit since IPOing earlier this year, and thanks to their sales doubling last year, along with posting some very healthy profits, their stock price valuation is actually pretty reasonable at a P ratio of 22 and a PEG ratio of less than 0.5. But personally, I just think that the market they operate in is a little too risky, and I feel like it's riskier than other stocks on today's list. And if I really wanted exposure to crypto, I'd rather just buy the coins themselves or eliminate the risk altogether by buying indirect stocks that still have exposure to it, like PayPal, who allows crypto to be used through Venmo, or something like Nvidia or AMD that are used for mining crypto, but they have businesses that are completely independent from it. So for those reasons, I'm sorry, I know some of you are probably going to be upset with this, and I'm a little upset with it myself because I think if you like the idea of cryptocurrencies and you like Coinbase, it's looking like it's at a great price. But I think there's way better options out there and much safer ones too. So I got to put it at number 9 at the bottom of the list. I mean, this is a stock that I definitely would not buy myself, so I can't be a hypocrite. I like the other stocks a lot more. So anyway, it's going at the bottom of the list. I just think there's better options out there. Like I said, I'd rather buy Nvidia or AMD before I touch something like Coinbase, but that's just my opinion. Anyway, okay, let's break in now to the top 3. And coming up first, it's going to be Roku. So ticker symbol is ROKU at almost 5.5% of the ETF. And I'm pretty sure you guys have heard of this one before, either by using one of their Roku standalone devices that connects to your TV and basically turns it into a smart TV by letting you stream various services and apps, or you might just have an already built-in Roku TV that have become very popular in recent years. I myself have 2 TCL TVs and they are both considered Roku TVs with the platform already built in as the base operating system. On top of that though, Roku also has their own streaming service that is similar to that of something like Netflix, except their version is only a free-to-use ad-supported platform, and while it's not as large or popular as the bigger players out there, they've already become the largest ad-supported video-on-demand service in the US, and that's definitely a market that I think will continue to grow. Meanwhile, Roku also commands the most market share as a TV operating system in both the US and Canada, and they're quickly expanding overseas too. All of it has given Roku robust revenue growth of around 50% or more every single year. The drawback is that they've never really been profitable, and with their new plans to develop Roku original shows and movies, I can only imagine that their profits continue to be way down in the same way that Netflix has. And despite the stock recently dipping to around the midpoint of their 52-week range, they are still up by over 1,200% in the past 5 years. So without much profitability and a price to sales ratio of over 20, Roku stock is probably a hard sell for most investors at these higher levels. Still, I gotta say, I've always loved the idea of Roku. I just think it's a super competitive market with giant behemoths that I wouldn't really want to go up against myself. So for those reasons, I'm gonna have to put Roku in the back half of the list at number 6, and I'll move Twilio, Shopify, Unity, and Coinbase all down one spot so that I can fit them in. Okay, we are now down to stock number 2, and here we've got a healthcare related stock that I've actually been meaning to buy myself, but just never really got around to it, and that is Teledoc Health, ticker symbol TDOC, at over 5.5% of the ETF. And this is the largest telemedicine company in the United States that specializes in helping doctors talk with, treat, and diagnose their patients virtually without them ever having to leave their home. And that's obviously been a huge benefit during the pepperoni lockdowns where a lot of people have been staying home much more often, which initially sent the stock soaring to a high of over $300 a share before it came crashing back down to now just the $140 range today, which is a crash of about 55% from those highs. Still, there are plenty of reasons to be optimistic about Teledoc's future despite the recent pessimism from things slowly going back to normal. According to Fortune Business Insights, the telemedicine market is still projected to grow from $41 billion in 2019 to almost $400 billion by 2027 at a huge compound annual growth rate of over 25%. For context, Teledoc only did about $1 billion in sales last year, so that's around 400 times smaller than the market opportunity. So it leaves a huge opportunity for growth, and so far that's exactly what we've been seeing from Teledoc. Last year, sales grew by almost 100%, and they're still expected to grow by another 84% this year and another 29% the year after as well. Granted, this is yet another company on today's list that is not currently profitable, but with these higher revenue growth rates, that price to sales ratio of around 12 is not only much smaller than several other companies that we've been looking at, but it'll also come down fairly quickly too, as long as they're able to execute over time. For those reasons, I gotta put Teledoc at number 2 right now because I think this is a stock that is definitely worth gambling on right now for the long term. Of course, that brings us to the final stock on today's list, and that is the largest of the entire ETF in Tesla, ticker symbol TSLA, at over 10% of the ETF, the only stock that is in the double digits. And I'm sure I don't have to explain much about Tesla, as there's probably a decent amount of you that are even already invested in Tesla yourselves just because it's such a popular stock. And by the way, it's also the second largest stock in my entire portfolio as well. But I'll just quickly mention that they're, of course, a huge play on the future of electrification and autonomous driving with their Tesla vehicles, as well as renewable energy with their battery and storage products and technologies, ride hailing with the planned launch of a robo-taxi service in the future, freight with the upcoming semi-truck, and most recently, they even went as far as to announce a Tesla robot. I know, it's getting pretty crazy with Tesla. Now, of course, these are all markets that will undoubtedly become much larger over time, and so far it's been leading to excellent growth for Tesla. In fact, during last year's recession, where almost every automaker saw big revenue declines, Tesla was actually able to post revenue growth of almost 30% and are still managing to grow by almost another 60% this year as well. As a result, their profitability has been improving every year, with last year seeing a full year of positive net income as well. And despite the stock trading so high after climbing by over 1,000% in just the past 3 years, that really high growth is even helping their valuation come down over time, as their PE ratio drops from over 350 trailing all the way down to less than 150 forward, meaning that valuation is coming down very quickly as long as the growth continues. I know it's an expensive stock, it's speculative too in a certain way, and there's no way to sugarcoat any of that, but Tesla has the opportunity to dominate multiple markets that I think will be gigantic in the future. And thanks to their high growth, their valuation is also coming down quickly over time, and I think that's going to even accelerate when they start to bring in huge profit margins from a robo-taxi service. And because it's currently my second largest stock in my entire portfolio, I think I'd be a little hypocritical if I didn't rank Tesla extremely high on this list. And for me, I feel totally fine putting them in the number 1 spot. I definitely believe in them more than any other stock on this list, but I admit I'm probably biased based on my own specific research. Anyway, I like them. They're getting the number 1 spot. Okay, there you have it, guys. We've got the full ranking here, and that's going to be Tesla at number 1, Teledoc at number 2. For number 3, we've got Spotify. Number 4, we've got Square. Number 5, we've got Zoom. Number 6, we put Roku. Number 7, we put Twilio. Number 8, we put Shopify. Number 9, we put Unity. And number 10, we've got Coinbase. Overall, though, I think this is definitely a very high risk, but also very high reward kind of speculative ETF. Personally, I love a lot of these companies, I really do, but I just think that their prices are way too high, especially as we go through the global health issue that I think has actually benefited many of these companies on this list. So I kind of just feel like I missed the boat on a lot of these, even though I do kind of like some of them. And of course, I also own a couple of them myself. But overall, I think most of these are just a little bit too out of reach for me myself. But let me know what you guys think down below. Do you own any of these stocks? Are you thinking about owning any of them? And how do you feel about my overall ranking? Do you agree, disagree with any of it? Would you make any changes? Let me know down below. I'd love to hear those thoughts. And anyway, thank you guys for stopping by. Thank you for the support. I really appreciate it. Hope you're all doing well. I'll catch you in the next video. Take care. Bye-bye.